Velocity banking, how do we get started? It's like a fire hose. What are the
Yes.
first steps? What do I do?
I always start with, what's your goal? What's the point? Why are we even here? I think I surprise some people when I meet with them because my approach is a little bit different. But before we even talk about how do we get started, it's what is velocity banking in general, even. So if we were to jump right in, so what is velocity banking? Velocity banking is the art of using your income from your paycheck. Traditionally, it goes into the checking account. And that's still okay. So income goes into your checking account. But what do you normally do from there? Normally, that money goes from your checking account to a bill. The thought process is you would actually take that money from your checking account and put it all of your income onto a debt tool. And from that debt tool is where you would pay any bills that you have. Now, ideally, if you were to do that, because I've got my cash people over there saying, but wait a minute. One, I have bills that I can't pay by credit card or I can't pay on some debt tool. So what happens if I put all of my income there? And then on top of that, what about my emergency fund? What about that extra money that I need to be able to, in case something happens? If you use the right debt tool, all of that is still available, meaning any emergency can still be addressed and you still have access to all of your money. But in turn, what you're doing here is you're actually using the same dollar multiple times. So think about it. Your money goes into your checking account, you use it to pay a bill. The minute you use that dollar to pay a bill, you can never get that dollar back. It's gone and it's gone forever. Versus you take that same dollar, you put it onto a debt tool. What does it do the minute you take that money from your checking account onto a debt tool? Well, it immediately pays whatever the balance that was due or the minimum payment that was due on that debt tool. So you use that dollar once to pay that balance, and then you immediately pay from that debt tool any bill that you have. Because again, just because you put all of your money onto a debt tool doesn't mean you don't have bills to pay. So you still got to pay bills, and so you pay bills from the debt tool. And so in essence, you've used the same dollar twice. And then once you've paid those bills, where does your cash flow live? Your cash flow ends up living on the debt tool. So before, all of your cash flow was living in your checking account. But now your cash flow is living on the debt tool, which does what? It drives whatever that balance is on the debt tool down faster. How do you get started? Like, what are those steps? Like, what do I do? Well, it kind of starts with obviously knowing your numbers. And every video that I've watched on where do I start, it is you first have to understand where the problem is. Do you know your numbers? And what does that even mean? Meaning making sure there's clarity around where money is going and what it's doing. If that clarity isn't there, you could really put yourself in an even worse situation.
Right.
And usually every video I've watched stops right there. Know your numbers, identify your debt tool, build a plan to get there, and you got to commit. Usually stops right there. And I think I surprise some people when I meet with them because my approach is a little bit different. You got to know your numbers, right? Income, expenses, total debt, cash flow, I'll call it a pretty simple statement to make, but it can become quite complicated to kind of identify where everything is coming from. But the bottom line is you have to understand your numbers in order to effectively do velocity banking. What we've decided to do today is kind of use a call I gotten recently around, hey, can you help me eliminate $20,000 in credit card debt? And when I asked for the numbers, what I appreciated about this gentleman is he fully understood where his money was going. And in kind of identifying what his numbers were, if you notice that bottom number, that cash flow number is pretty significant. Brings home $5,000. And again, these are rounding, but brings home around $5,000 a month, has expenses of about $3,300. He's looking to address a specific bill. And this bill, this $20,000 in credit card debt, it's a $20,000 credit card, and it's maxed. It's like 19,486 or something like that, but it's roughly maxed out. But he's got 1,700 in cash flow. And as it relates to a debt tool, there weren't really many options to go after. He's currently renting, and he doesn't have a whole lot of credit card. That one credit card that's maxed out is the only credit card he has. He could apply for a personal line of credit, but he has a different goal in mind. So he only has the one credit card. So his debt tool that we're going to use for this example is that credit card. I kind of caught him off guard because he was expecting me kind of to just jump in and kind of talk through how he could use his cash flow to eliminate his credit card debt quickly. And I kind of paused for a minute and I just asked a very simple question. But what's your goal? Because from my perspective, even though we talk through the steps of know your numbers, identify a debt tool, make a plan, and then commit to addressing, the debt in a consistent fashion. I always start with what's your goal? What's the point? Why are we even here? And from his perspective, his goal was to eliminate that credit card debt hard stop. But when you start to peel back the layers, you understand that actually it's not just to eliminate credit. Like, why are we eliminating the credit card debt? I understand that it's maxed out. I understand that it shouldn't be there. But what is the goal behind this initial or this surface goal? And as we started to peel the layers back, what I learned is the gentleman wants to buy a home. He's 35 years old, married. He's on a mission to be able to, within the next, I think, 3 years, to be able to buy a home. And what he's learned is this credit card that's maxed out at $20,000 is impacting his ability to be able to do so. But you can peel that layer even further. Is it just about, because once you buy the home, once you've cleaned up your credit, you've qualified for this home, you've used velocity banking to be able to get yourself in position to buy the home, you've bought the home, you're in the home, awesome. But then what? Like, what's the goal behind that?
Right.
And he had some specific needs as it relates to this house. Hey, I want a 15-year mortgage. Why do you want a 15-year mortgage? So that I can pay this home off in 15 years. Well, why do you want to pay the home off in 15 years? Like, what are you looking to accomplish? And long story short, what we learned is his objective was really more around creating a legacy, building generational wealth, and putting himself in a position such that he can do what he wants when he wants. And based off his timeline, he was kind of compartmentalizing things, right? I need to address my credit, get rid of this credit card debt, buy this house. And then once I do all of these things, then I can start focusing on legacy and, generating wealth, if that makes
Well,
sense.
and there was another piece because they want to have a baby
Oh,
and they
no
want a
doubt.
home. They want a home to have that baby in. And so I came to advocate from a girl who was over there saying, "Can we please get a house? Can we please make this a goal because I know these are the steps and I want to do this in a responsible way." But I want a home to bring my baby home to. And so for them, this has now become urgent, right? So he's going, what are the steps? How am I going to strategize to make this happen? And so not only does he have the pressures of he wants to, build the legacy, but he also wants to make good on this dream for her too, right? And for them. So
Absolutely.
there's a lot of emotional pressure there too.
And it was pretty interesting because that didn't come out until later, as far as the significance of really, it's really not about the home. It's about, hey, we need the space because we're wanting to start our family, and we really, want this snowball to start rolling down this mountain so that it can become a boulder, right? So
Right.
that didn't come out till later, but you're absolutely right. Again, but I go back to what's step one. Step
Yeah.
one is understanding, why are we doing this?
Right.
Like, what
Yeah.
is the real goal? It is not just debt elimination. It is
Right.
not just paying off a bill. Because think about it. Let's say you do velocity banking and you've paid off that credit card. Awesome. Awesome. If you really don't have any goal in mind, then that credit card is sitting there empty. You have cash flow sitting in your checking account. How did you get in this place to begin with? You probably got into this place to begin with because you had cash flow available to be able to use. So
Right.
unless you're doing this and putting yourself in a position such that you can use that cash flow to, I'll call it, accomplish another objective, you're kind of setting yourself up for maybe even what is it called, backsliding, making a mistake and ending up back in the same predicament that you were already in, right?
Well, yep.
And usually the velocity banking process is pretty linear, right? It shouldn't be, but in essence, if I do velocity banking and if I'm, starting at a certain point and, follow all the steps again, I commit, I know my numbers, I identify a debt tool, I put a plan in place, and then I eventually get there. And in this gentleman's case, his goal is to, right, get a house, put himself in a position so that, hey, a home can be purchased and we can start building this family. Pretty linear process. But again, as we start peeling back layers, though, the truth is all of us, all of our goals really look more like this. It's really a bit more complicated. And that home or becoming debt free or whatever those actions are, that's really just a small step in this process of really getting to whatever the goal actually is. For some of us, it's wealth. And again, wealth is relative. For some of us, it's retiring early. It just really depends on what it is. But my point is, it is not as simple as, hey, once I put myself in a position to buy this house, I'm done. It's really understanding what your goals are and are you putting yourself in the right position to be able to achieve the main goal.
Yep.
So for this gentleman specifically, again, he had some basic wants. It was, hey, I need to pay off this credit card debt. I'm giving myself a 3-year window so that I can improve my credit. And again, if you look at his profile, looking at his numbers, I pulled it up earlier. Other than the $20,000 maxed out credit card, what else is there? Well, he does have a fair amount of student loans. And I personally believe it's the student loans that's having more of an impact on his credit. But addressing this credit card debt again because of his cash flow is pretty simple. So pay off the credit card debt, improve his credit utilization, improve his DTI, improve his ability to be approved, buy a home. And again, he has a goal of paying that home off in 15 years. Again, when I ask why, and again, that's kind of I'll call it a silly question to ask, I know, because why else would anyone get a 15-year mortgage? It's so that they can pay their home off in 15 years. But again, go a little bit deeper than that and look at it from your own perspective. If you paid off your home right now, how do you benefit? Okay, the mortgage that you're paying right now, you're no longer paying. Okay, so your cash flow increases. Awesome. But how else are you benefiting from paying off your home? It's an asset that you're still living in, you're still paying bills from. How are you leveraging that asset to be able to put you in just a better position in general? Is it just the no longer paying the mortgage that you're satisfied with? For most of us, this is a 150, 200, 250, 300, $800,000 asset. Wouldn't there be an opportunity to leverage that asset a little bit better to put you in a better financial position? But anyway, buying a home and paying it off in 15 years was the goal. And then the last one being retire early. And as I mentioned, my objective is to kind of peel layers back. If you tell me you want to retire early, my first question to you is going to be, how? What vehicles do you have today? What vehicles are you contributing to today to be able to retire early? And for most of us, as it relates to the word retire, we have some basic vehicles. IRAs, 401ks, 403bs, TSPs, government 457 plans. With those traditional retirement planning vehicles, which one of them will allow you to retire early? How about none? And so if the goal is to retire early, my question is, what vehicles are you using to get you there? And if it's about a traditional retirement account, I'm sorry, but it doesn't exist. So I then bring that up to the top of the list. To me, if the number one goal is retire early, it's how do you structure things so that you can start focusing on that? And again, this gentleman's 35 years of age. And so based off his goals, we built out a scenario.
Right. The way he thought it should go.
Exactly. Usually the conversations that I have are very, I'll call it straightforward and linear, meaning if I do these things, these are the results. And in his case, it was, hey, the first thing I want to do is use velocity banking to put myself in a much more credit worthy position. And as that cash flow increases, I want to also start to address these student loans. And I honestly believe that's impacting his ability to be able to qualify for a home more than this $20,000 credit card. Yes, it's maxed out. Yes, its utilization is maxed. So getting this payment down makes sense. And so that's kind of the goal. Based off his income, as I mentioned, he's got about, about $1,700 in cash flow. Meaning using that cash flow and using that cash flow against that $20,000 debt, he can easily use velocity banking to get to a point where that credit card is, I'd say, within, let's call it 15% of the limit. And once you drop below 20%, there are some specific actions you should take. One of those actions is, hey, reach out to the credit card company and get that credit limit increased. Why? Just so that he has more room, so that he creates more distance, and he doesn't hit his utilization as quickly. So in about, I'll call it 6 to 8 months, there's no reason why, using the cash flow that he has, is that this credit card isn't paid off. And the other step that we had taken is, okay, if you do that, then use the remainder of that time, because he has a 3-year window to be able to put himself in a position to be able to buy a home. So use the remaining, what is that, 24, 28 months or whatever that time frame is, to start to chunk away at his student loans. And in chunking away at his student loans, that allows him to be in a much better credit worthy position at that 3-year mark to be able to purchase this home. When I asked what was your true goal, what was your main goal, what he shared with me was he is putting away $500 a month in a high yield savings account. Okay. And that high yield savings account, I think, is bringing him 3%. So that $500 a month for that first 3 years, inside of a high yield savings account, that $500 a month would equate to about $18K. So, and the reason I share this is that $18,000 is enough for that 3% down payment on that $300,000 home. $300,000 home, 3% down payment, $9,000. And so within that 3-year period, there is nothing preventing him from being, I'll call it, in position to be able to buy this house. But again, what happens after that? Well, the thought process was it would take him 15 years paying that house payment to get the house paid off. Okay, so in 15 years, once that home is paid off, then what? The thought process was, okay, at that 15-year mark, now it's time for me to focus on retirement. So let's look at some numbers, some age related numbers. He's starting this at 35. By age 38, he would be ready to buy this home. It's a 15-year mortgage, 38 and 15. He's 53 years old by the time he pays off this home. 53. He's starting his journey to creating generational wealth at 53. I'm not saying it's not possible. The dot I want to connect is that's pretty late. What are we doing between 35 and 38? What are we doing between 35 and 53? And yes, he is contributing to his company's 401k, but what he's looking for is a vehicle that can grow him, create generational wealth outside of his traditional retirement planning at his job. And okay, he's got this $500 a month going into this high yield savings account. Is that going to do it? And now, truth is, let's say at the end of the 15 years, he's got some money available to him. Here's what I know. I know doing that this $300 a month payment equates to about a $2,100 a month mortgage payment that he's paying on that $300,000 home. So at the end of the 15-year period, that $2,108 a month is now gone away. So okay, there's additional cash flow at age 53, and $2,100 a month is a significant amount of cash flow at age 53 to be able to put away. In addition, he's paid off the home. So assuming he's going to leverage his home, there's a $300,000 lump sum. That's significant. That $500 a month that's going into that high yield savings account, again, it's high yield savings account, 3%. I think it's a 3% a month or whatever that rate is, or how it's calculated. But using a compound interest account, we determine that's about $128,000. So that's significant. So $300,000 home that I can leverage, $128,000 inside of my high yield savings account, the $500 a month that I was contributing, plus the $2,108 that I was contributing as well into my mortgage that I'm no longer paying. That's a significant amount of money at age 53. But what does that equate to?
Yeah, because it doesn't equate to retirement income at that point.
But let's be specific. It equates to $72,000 a year. And again, this is using a secure compound interest account.
Right.
It equates to $72,000 a year tax-free. Again, using those large dollar amounts. And why is it only $72,000? It's because he said his goal was to retire early. I asked for a number. Said, I want to be able to retire when I'm eligible to be able to touch my company's 401k, because I'll have both. So his goal was to retire at age 59 with a 6-figure income. And just using his math, We step through how can you achieve a six-figure income using your current vehicles that you have available. And again, that is waiting till 53 before you start focusing on it, and using the equity, the mortgage, and the money that was sitting in that high yield savings account to all of a sudden jumpstart retirement. And it just simply using his process of doing things, we ended up with about $72,000 tax free. And I asked, is that sufficient? And he was not happy with that.
To his point, he's putting in his company 401k. This is the whole reason why he's invested in that. This is the whole reason why he's taking these steps, is so that he'll be okay and everything will be taken care of. He's really thinking about it in, okay, from everything that I know, these are the steps. This is the way that you build wealth and that you have a secure financial future. But the reason why we pointed it out in this way, and this is just the point that I want to make, is that this is very linear. And
Right.
this is if this, then that. That's what this is a statement. And
It's
this,
the compartmentalized thinking. I can't accomplish this goal until I can't accomplish the next goal until I've accomplished this goal.
you can't have your dessert until you've cleaned your plate,
Right.
right?
Right.
And so therefore, and we all get that concept, right? That's very familiar to us. And we're just programmed to be like that. Okay,
Standard
if I,
conditioning.
yep, if I do this, then I can focus on that. In addition, a lot of this stuff is overwhelming and it's a snooze fest to learn. So it's boring, it's overwhelming, it makes you feel anxious. And so if you can just grab onto one nugget, one, and just do that for a while, and you feel like, okay, now that I know that I've got this and I've achieved this goal, now I can move on and I have the time, the mental capacity to do something else. And so that's where I think this linear system has to be represented in this way, because we all approach it this way. Here's the
Right.
point. When you go to watch some of these velocity banking videos and you're learning the process of velocity banking, coming up with your plan, everybody makes a plan like this.
Right.
Everybody.
It's pretty standard.
Yeah.
Pretty standard.
Everybody's plan looks like this, and this is part of the problem of realizing that you can't get the time back. So the cool thing is we know how to supercharge this. That's the benefit. The cool thing is we're looking way past that house, way past the debt, way past the next 10 years and what they look like. And that is not a goal at all. It is a part of the process. It is a step in the process. But by the time you get there, man, you're not going to have to go, okay, now that I got that, let me try to stomach the next part that's coming and hope that those same opportunities are there, right?
Right. Right. But what is the true goal? Again, if we're talking about buying a home and paying that home off, that's only part of the process. Once that home is paid off, what is the true goal? And he was very, very adamant about generational wealth. He wants to be able to put his family in a position such that for the next 500 years, they're taken care of. And so my question was, okay, you're here. What are you doing right now at this point to be able to get here? Like, what steps are you taking? And if you go back to the numbers on the previous slide, if you're 53 by the time you pay this home off and you're trying to retire by 59, that's a pretty long distance to go to be able to create generational wealth. And so again, it started with just some very simple questions. What's the goal and why is that the goal? And here's what we learned as we kind of peeled these layers back. Yes, the goal is to buy a home. But why a 15-year compared to a 30-year? Because I want to pay the home off faster. Okay, if you pay the home off faster, what does that accomplish? Well, in the midst of kind of peeling these layers back and identifying, yep, they want to build a family, want to have a family, and they want to make sure the place is large enough for that family. What I learned out of that was their goal. This gentleman's married to a young lady from South Africa. Their goal is to eventually even move out of the country. So what that means is the retirement goal is to not even be in the States. So if the retirement goal is to not even be in the States, then whether you pay the home off in 15 years or 30, how does that impact or change or shift or help your ability to generate that wealth, especially by age 59?
Will they be done with it?
Right. And so we just had a lot of conversation around the home in general. And so the first few steps were the same though, right? It
Right.
was, hey, use velocity banking to eliminate debt. And when we use that velocity banking to eliminate debt and pay on your student loans, your credit improves. And now once your credit improves and you have a down payment, you're able to go buy that home. But I started with an action to help him get to his original goal. And that action was, you've got cash flow. His cash flow is right around $1,700 per month. So what if you take $500 a month and put that into a secure compound interest account?
Yeah.
What if you simply use, because again, the cash
Up
flow is
front.
there. He's got $1,700 a month available to him. What if you just simply take that $500 a month, take $500 a month out of that cash flow and start a secure compound interest account? Meaning you're starting a vehicle, you're putting your money in a machine that can actually help you get to retiring early. Because as I mentioned earlier, name one other vehicle, especially as it relates to traditional retirement, that can help you get to early retirement. And most people say real estate. So unless you're buying properties, flipping those properties, or buying holes to sit on those properties to generate income over time, what other vehicles are there that's going to help you retire early? And again, he's a biochemist actually. And as a
Oh.
biochemist, he doesn't have a whole lot of time on his hands. So real estate isn't an option. This has to be passive.
I was just gonna say, you gotta be into it. It's not just go do this. You gotta really be into it.
Right. So the first thing we did was we identified that, oh, okay, so what are those vehicles? What is a vehicle he could start right now to be able to produce, to at least start down the path of creating generational wealth? So it started with putting $500 a month away in a Skia. And then using velocity banking to eliminate debt and address his student loans. What that ultimately did was it started him down a different path than what he was expecting. And then the down payment for the purchase of a home is still coming out of a similar place. Meaning, for his example, on that 15-year mortgage, the down payment was coming out of his high yield savings account.
Right.
Well, if he's putting $500 a month away into a secure compound interest account, that is a savings account.
Right.
But
That
here's the
grows
difference.
faster.
But here's the difference. The high yield savings account, let me just, well, I think the number was around 18 grand. Over that 3-year period, he would have accumulated around 18 grand, $500 a month, around 18 grand inside of his high yield savings account. The down payment for a $300,000 home, 3% times 300,000, $9,000. So the down payment is a $9,000 payment, or a $9,000 amount to be able to put a down payment on that $300,000 home.
Yeah.
Okay. When you take 9,000 out of the 1,800 of the high yield savings account, what's left? Okay, there's $9,000 left, meaning you eliminated 50% of your high yield savings account. Well, as it relates to a secure compound interest account, if you needed $9,000 at year 3, you would be able to leverage that $9,000 from yourself, which means you're not depleting that 18,000.
Right.
The life insurance company is writing you a check for 9,000. There is an interest rate tied to it, but it's a simple interest, 4% interest rate that you choose whether or not you want to pay it or not. But the bottom line is, that $9,000 check is now being used to go purchase this home, but your 18,000 is untouched, which means
It's
that
still
money is
growing.
still working for you.
That's
That
right.
machine is still building over time with that $18,000. So at a minimum, he didn't hurt him, because again, goal is to retire early. MPI is a vehicle that he's going to use, or secure compound interest account is a vehicle he's going to use to get him to retire early. And even leveraging the 9,000 that he needed for this home, he's not hurting himself.
And he's wanting uninterrupted growth, uninterrupted progress is what he was seeking essentially in all of his terms that he listed in his goals. I don't know if you guys can see that little VIP pass I added there. It means that now you have the VIP pass because you've prepared yourself. So by having the secure compound interest account, you're putting yourself in a position like having a VIP pass that you get to now take these shortcuts, right? You get to now take a different path, and you get to now the hacks and life hacks or financial hacks or whatever those are, you get to take shortcuts that other people just simply cannot because they don't have leverage and they cannot take advantage of the opportunity. So that's why.
And now, also looking at ages. So again, starting the same process at age 35, and then buying this home at age 38. Now, from age 38 to age 59, his objective is to retire early. And notice, I have retire early, not the end game. The retire
Right.
early is just another step in this process.
Because what he didn't say, the unspoken end game was legacy, was generational wealth. He just didn't
Yeah, it
list
absolutely
it.
came out. It
Yeah.
was about generational wealth, and generational wealth just means, hey, I want to be able to leave a legacy. And so, because retiring early was not the end game, I wanted to make sure there was a process that we identified to help get him to that end game of generational wealth. And so, in creating the 30-year mortgage and the savings on that 30-year mortgage compared to the 15-year, again, there was additional money that was available to then put into a secure compound interest account. What it does is it helps this process move by faster. And there's an item that we didn't even discuss. I laid it out there on paper form, but we didn't specifically walk through it. And that was, what if you converted that 30-year mortgage to a first position HELOC to be able to leverage even faster? But even taking that out, from age, what is that, age 38 till 59, just paying the normal mortgage will allow him to be able to get to a point.
No, that's the with the $1 million baby. You took the $1 million baby shoot.
No,
Flag on the field, Chris. He was definitely out of bounds on that one.
the $1 million baby is an option, is an
Yeah.
additional option. But
Yeah, I
even
know.
without that, pulling that lever of the $1 million baby, which we'll talk about, even without that option, his ability to be able to get to 109,000 in tax-free income is still the same because it's just math. It
Yeah.
is based off this $500 a month that he was contributing, plus the $676 a month that which is the difference between a 30-year and a 15-year mortgage, and plus that secure compound interest account, the amount that he had accumulated in the first 3 years. The first 3 years was right around 18. I think it was like 18,360. And so, in the process of putting these dollar amounts inside of a secure compound interest account, is what got him to that 109,000 of tax-free income for the rest of his life. But again, along this way, there are other levers that can be pulled. One was the home, converting the 30-year mortgage into a first position HELOC. How do you leverage that? The other is, yes, as you have kids, as you make more money, as you grow in the company that you work for, you're also earning more income, which means your cash flow should change. Your cash flow should improve. This is assuming no change in cash flow. But let's say his cash flow does change, his cash flow does improve. There's an opportunity to introduce a secure compound interest account for your kid.
Well, you could leverage your current policy to do that too.
There's all sorts of opportunities here.
You leverage the HELOC to do that too.
Again, they don't call it infinite for nothing. There's
Right.
all sorts of opportunities here. And I
But
think the key here, the piece that I just want to make sure sticks is this. How do we come up with a concept like this? How do we come up with a process like this if we don't fully identify the goals?
right.
And my point is, when you're doing velocity banking, it's not just about that debt that you're wanting to eliminate. It starts with, first, what is the true goal? What is the object? Once this debt is eliminated, then what? Once that mortgage is paid off, then what? And is there something you can institute starting now to put yourself in a position to be able to achieve the actual goal? Because here's my point. Because he started this secure compound interest account at age 35, because he started here putting away $500 a month, this $500 a month has been compounding for 3 years before we even added this dollar amount. And when we added this dollar amount, I'm sorry, this $500 a month had been compounding for 3 years. And then when you add this dollar amount on top, it just compounds even more, which puts you in a position to be able to achieve that 109,000 tax-free for life.
For
And
life.
for life. And a lot of words, but let me show you how. So again, He started his secure compound interest account when he was 35, but I'm going to start at age 38. So he's been doing this for 3 years, age 38. And we're going to compound this thing till his desired retirement age of 59. So that's his early retirement age. There's a lump sum going in here. He had this secure compound interest account for 3 years. During that 3-year period, there was an amount accumulated. So I'm going to use that as the amount of lump sum that we're putting in here. If you remember, it was 18,360. And his monthly contribution was a combined dollar amount. It was the dollar amount from those first 3 months, the $500 a month from the first 3 months. And then now that he's gotten this 30-year mortgage compared to a 15-year mortgage, his monthly payment reduced, and the difference between what he was willing to pay and what he's currently paying is all I'm using. I'm not coming up with a new additional dollar amount that's separate from his cash flow. He was already prepared to pay $2108 a month because he wanted a 15-year mortgage. All I'm doing is saying if you take a 30-year mortgage instead of a 15-year, that difference in payment, difference between 2108 and 1432, that difference is 676. So $500 a month plus 676 equates to 1176. So if he was just simply putting away from age 38 to 59, that 18,360 lump sum plus 1176 a month, it equates to $109 tax-free for life. But let's break this down a little bit. This $109 is that annual income. And that's starting at age 38. He would have accumulated cash value of almost $1 million, $958,000. And his ultimate goal was legacy. Well, this vehicle builds legacy as well. And what I mean by that is if something were to happen to him, he's purchasing a life insurance policy for about $700,000. But as this compound, as it grows, the death benefit, which is two numbers, the death benefit, if something were to happen to him later in life, is the life insurance plus all of the cash value that wasn't used, which equates to a total of $2.9 million. Show me the high yield savings account that can produce a legacy of $2.9 million. It just doesn't exist. And so in simply starting earlier and being diligent about or committed as to what the goal actually is, put him in a position to be able to achieve this $109,000 tax-free for life. And again, it's all starting at age 38 till age 59, that one-time lump sum of 18,360 and 1176 a month in contributions, and he's there. And notice, I don't have him making more money.
Right.
I don't have him converting his 30-year mortgage into a HELOC.
That's right.
And I do not even have him doing policies on his children, which you're absolutely correct. Because of this projected cash value here, he can use a portion of this dollar amount to open up policies on his kids. He doesn't even have to come out of pocket to do that.
That's right.
So there's just so many layers here that aren't discussed. And I go back to the original question around what are the goals. If your goal is to retire early, what other vehicle do you know will allow you to be able to touch your money at age 59 without being penalized?
That's right. I love it. Great job. I think that these steps are going to change the game. They don't align with other people's steps out there. So there's that. We also
just to restate that, when if you were to put in the search bar of YouTube right now, where do I start?
But don't do that. Stay here.
Of course.
Okay.
But how do I get started? What you're going to see is know your numbers, right? Identify a debt tool, personal line of credit, credit card, whatever it is.
Make a plan.
Make a plan. Meaning,
how do you make the plan?
Going? Where are you headed? Where are you headed? And then you have to be committed. From my perspective, I think it looks a little bit differently. Order matters. Because the way this reads, know your goal, know your numbers, identify a debt tool, make a plan, pay yourself first. From my perspective, the first step one is knowing where you're headed. So what is the goal? What's the point? But the second step is to pay yourself first. And I don't care what your goal is. If your goal is to eliminate debt, if your goal is to buy a home, if your goal is generational wealth, if your goal is retire early, How do you get there if you don't put yourself first? And paying yourself first means exactly that. Before you pay a bill, before you pay your mortgage, before you pay Netflix, pay yourself first. Put your money in a position such that it's working for you. So know your goal, pay yourself first. And then if we're talking velocity banking, you have to know your numbers. You have to understand what's going in and what's coming out. And then identify a debt tool. What tool are you going to use to be able to address this debt by using velocity banking? What tool are you going to use to be able to do so? And you have to commit. You have to make a plan. You have to sit down and kind of map out how you're going to achieve these things.
How do you get started? Well, we made a tool for you. And now we get to finally show it. So we've had about, I don't know, 20 people now grab this. We had made a post about it. We started that Facebook group because people were in the comments like, yes, I'm in. Let's do a Facebook group. So we started one. So you can go to selfdirected.info/live right here. That's where you get it. And about halfway down, you'll see the calculator. Click on the button, tell us where to send it, and then we'll give you all of our free tools, which includes 2 free books, a comprehensive video series on secure compound interest account, how it works, why it works, and it answers a ton of questions in there for you. What else do we have in there? Oh, case studies. We have tons of case studies. And then, of course, you get Donnell's digits. So now you can text him anytime with any questions, which many of you have, and we welcome that. So anytime you have a question, whether you're in with the calculator, if you are reading the books, watching the videos, it doesn't matter. If you have questions, text them to us in real time so that you can get that answer. And the Facebook group, honestly, guys, is a place to meet other people who are on the same journey as you. That's pretty valuable because a lot of us, we're the pioneers, right? Out here breaking cycles. And our mantra is, if you did not come from a wealthy family, make sure a wealthy family comes from you.
That's right.
That's how we're going to do it.
That's right.
We're going to start over our ending. We're trying to work on our ending. It needs to be cool, and we just haven't figured it out yet. Okay, I'm Angelique.
And I'm Donnell.
Okay. Thanks for tuning in. Okay, we're going to ask ChatGPT and do some outros next time.